Chapter 1. The 25% Annual Return. Why everyone with six figures to invest should consider angel investing. Angel investing in the past few years has moved from an arcane backwater of the financial world to a business arena that receives coverage in mainstream newspapers and hit television shows such as ABC's Shark Tank. Today, any sophisticated investor with a portfolio of alternate assets should consider direct early-stage investments in private companies as one potential component of that portfolio. Why? Because multiple studies have shown that over the long run, carefully selected and managed portfolios of personal angel investments, even those without a giant hit such as Pinterest, produce an average annual return of over 25%, compared to average annual returns of 1% from bank accounts, 3% from bonds, 7% from stocks, 10% from hedge funds, and even 15% from top-tier venture capital funds. That is an impressive number. What is even more interesting about angel investing is that, unlike sitting back and clipping coupons or reading the stock listings in the daily paper, being involved as a part owner of an exciting startup company can be a great deal of fun. You get a ringside seat at a venture that is out to change the world, direct access to company CEOs who may become the corporate magnates of tomorrow, and early access to the latest products and services before they become generally available. You may even have the opportunity to advise and mentor a company as it develops, pivots, and changes its business plan in response to real market experience. By now, this must sound too good to be true. Outsized returns and having fun? What's not to like? But here is the sobering reality. A large majority of self-proclaimed angel investors actually lose money rather than make anything at all. How can these two facts be reconciled? Simple. Those 25% plus returns are, quote, over the long run on carefully selected and managed portfolios of angel investments, end quote. In practice, however, most people who call themselves angel investors do not carefully select or manage their investments, do not take a long-term view, and do not have a clue about how to approach angel investing as a serious part of an alternative asset portfolio. But you want to understand how to engage in angel investing as a serious part of your investment allocation. So let's begin with the basics. What exactly is angel investing? Angel investing is when individual people, as opposed to professionally managed investment funds, corporations, governments, or other institutions, invest their personal capital in an early-stage company, often known as a startup. Angel investors are individuals who invest their own money, typically in small amounts, and typically very early in the life cycle of a company. Angels find investment opportunities through referrals from people they know, such as CEOs of companies in which they've already invested, through attending regional or national events at which early-stage companies launch their products, by being approached directly by ambitious entrepreneurs, through joining with other angel investors in organized angel groups, or increasingly by participating in reputable online early-stage investment platforms such as Gust. All of these techniques for identifying angel investment opportunities, and many others, will be described in greater detail in Chapter 5. The fact that angel investors use their money to back companies they hope will grow and bring them significant profit is not in itself unusual. Most mainstream investors do the same. They invest in blue-chip companies like Apple, Google, GE, and Coca-Cola, or in mutual funds that support an array of companies, hoping their money will grow as these businesses grow. The crucial difference between these mainstream investors and angel investors is that angels invest in startups, companies that are relatively new, small, and privately held, rather than publicly traded in a marketplace like the New York Stock Exchange or NASDAQ. Because these companies are like tiny plants striving to become giant trees, the first investments in them by angels and others are often referred to as seed investments. Unlike public companies, startups are often little known. They generally do not appear on the cover of Forbes or Fortune, and you won't hear them talked about by stock analysts on cable TV, or even by your favorite broker. So understanding what these startup businesses are like, where to find them,